Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Bitter pill, poison pill. Those are just two of the names bestowed upon Bank of England chief economist Hugh Pill, who this week said on a podcast that British citizenry needs to accept that, quote, we're all worse off and stop trying to maintain their real spending power, unquote, by doing things like asking for higher wages. Okay then. This week, our three things are: 1. Cost of capital. What does its rise mean for credit? 2. U.S. consumers. Will they continue to spend? And 3. Strong demand for credit. Why is it happening at this point of the credit cycle? All right, let's dig a bit deeper. So we've talked about credit entering a new paradigm, one where the cost of capital is materially higher, which means that it will be more difficult for firms to earn an acceptable return. One where capitalism's creative destruction returns to flush out zombie companies, restoring in the process a more rational competitive landscape. Our research shows that the weighted average cost of capital has fallen over the past 15 years, from over 9% to just over 4% in 2021, before spiking back up to 8.5% today. One more thing that has returned, for all intents and purposes, to normal. In fact, the longer-term average is right around 7%, so we're a bit above that level, as the rise in the risk-free rate has more than offset higher risk premia. In this new paradigm, which is really the old pre-QE paradigm, issuer cash flows will be tested by not only higher interest rates, but also slower growth, technological disruption, ESG sensitivities and costs, and heightened geopolitical uncertainty. Business models will be scrutinized. Is there pricing power to drive margin? Where and to what extent is there technological disruption? And is the issuer on the right side of that issue? Is the capital structure appropriate? On that last point, firm managements were encouraged to increase leverage over much of the past 15 years, as the cost of that leveraging was relatively modest in an environment where yields were engineered by central banks to be low and compressed across the credit spectrum. That obviously has changed. Not only is the risk-free rate higher, but risk premia have widened as we head into economic contraction, and both are likely to stay that way as bond vigilantes have returned to markets, which should limit fiscal stimulus and/or the degree of monetary accommodation that comes to the rescue of investors as that contraction tightens over the back half of the year. This is not meant to send a sell everything signal. With a mild recession the most likely scenario, the vast majority of double Bs and better will be fine. But it does argue for decompression across higher rated categories and lagging performance from the weakest credits. All right, on to our second thing, the indomitable U.S. consumer. Probably not an overstatement to say that as the U.S. consumer goes, so goes the global economy. So let's take stock of where the consumer is at the moment. This week's GDP report showed that the U.S. consumer will not go down quietly, with personal consumption up 3.7% year over year in Q1, a touch weaker than the 4% estimate, but the highest level since the second quarter of 2021. On the face of it, the number was clearly boosted by the unexpectedly strong start to the year, which saw warm weather and other factors providing a growth booster shot. So it's important to acknowledge deceleration through the quarter. Spending has been supported by two things. One, the still large, albeit dwindling, stockpile of excess savings, as well as, two, the confidence consumers have in their ability to stay employed at higher wage levels. And they have the capacity to keep this spend-a-thon going, judging by the Fed's financial obligations ratio sitting at just over 14 times. That's almost 4 turns below the GFC peak, while household net worth is still 26% above year-end 2019 levels. This really comes down to consumer confidence, the thing, maybe the only thing, well, probably two things if you count the Fed, that stands between expansion and recession. We know most folks do not feel particularly good about their situation right now. That probably has a lot to do with politics and inflation and the public discourse. But they are, for the most part, okay with regard to their financial wherewithal, as we've just discussed. There still is a degree of revenge spending taking place. Just look at travel categories. And not to sound like Hugh Pill, but there is inertia in spending patterns that formed out of the excesses of stimulus. It points out the very real phenomenon that consumers will spend until there is that moment, that realization that they need to dial it back. We're not there yet, but it feels like we are approaching that moment. And the speed at which that moment arrives depends a lot on the labor market and when it starts to crack. And by the way, it is starting to crack anecdotally through a seemingly daily barrage of layoff announcements, which is finally flowing into jobless claims. The pieces are falling into place for recession. All right, on to our third thing. Where is all this interest coming from? We had a discussion this week on the surprisingly strong bid for bonds, especially in parts of the asset-backed markets, in the face of deteriorating economic news. It made us think, where is this interest coming from? Now, peeling back that onion, we would make the following observations. Issuance volume is below expectations. The March events, or the bank failures, have depressed financial institutions' issuance, both in the U.S. and among prominent Yankee Bank issuers. Parts of the ABS market, CMBS and commercial ABS in particular, have seen issuance levels significantly impacted by the environment. And M&A issuance remains subdued in the wake of market volatility and economic uncertainty. A second point, the 60-40 portfolio works again. The foundational 60% stocks, 40% bonds portfolio construct makes sense again after years of TINA, as in there is no alternative to U.S. stocks, where investors saw little value in ultra-low fixed income yields. And that means there will continue to be strong demand for what makes sense here, up in quality, up in liquidity, and up in simplicity bonds in both the unsecured and secured bond markets. Another point, the recession is not here yet. Stocks have not fallen off a cliff largely because corporate earnings growth has not fallen off a cliff. Unemployment is at or near 50-year lows, and the consumer, for the most part, is in good shape. And the Fed is nearing the end of its tightening cycle, and rates are falling. And a final point, the recession is likely to be mild. Why would you buy risk at this moment when the forward-looking indicators say we are either in or at least we are clearly heading into a downturn? Well, the answer is because you have money to put to work and you have visibility which should enable all but the weakest and least understood credits to hold in. Add it all up, and you have strong demand for reduced supply. And that is holding in spreads for most credit subsectors at levels that do not reflect typical recession levels. Now, two catalysts are clear and present dangers: cracks in the labor market and bank credit crunch on top of Fed tightening. So there you have it. Three things in credit. 1, cost of capital. Its rise is a healthy return to normal. 2, U.S. consumers. Their spending is providing for a softer landing. And 3, strong demand for credit. Supply is lower than expected, and the desire to get back to 60-40 is creating plenty of demand. As always, thanks for joining us. Don't forget to check in on kbra.com for our latest research and ratings reports. See you next week. Hello, listeners. Join me, Van Hesser, KBRA's chief strategist, for in-depth conversations with credit experts in my new monthly podcast, Leading Voices in Credit, where I'll interview market professionals on the latest trends in credit markets. That's Leading Voices in Credit with Van Hesser. Subscribe now.